Okay, so this is Friday, the 5th of, sorry, the 8th of May. This is 8:45 in the morning to 10 o'clock in the morning. We're just going to do a quick market recap. Then we're going to have a look at our portfolios. And then lastly, we're just going to do about 10 or about 15 to 20 minutes on taxation on dividends and capital gains tax, just for those who are not familiar with how it functions and what your obligations are as a taxpayer. So the quick market recap, you can see it's pretty similar to the previous weeks. Oil has been the driver, has been the primary, or I would say one of the drivers of the week, especially for the US. It's nearly down 8% since we did the last podcast last Friday. The S&P and NASDAQ, you can see the NASDAQ is up 4.54%. This is on the back of this. On Wednesday, $1 trillion went into the AI stocks. It was a huge investment. So there seems to be a massive run up in AI stocks, which is currently what's holding the markets up, relatively speaking. But it could turn out to be real, which is we don't know until the events happen. In Europe, not a great, where Europe is just slightly down, just it's pretty much flat. And then you can see from the sectors, in the US, the infotech is obviously up 5.5%, and in Europe, industry is up slightly on the back of oil coming down. It's kind of the week is kind of driven by what Trump is saying, guys, more than anything else. The markets still seem to be following exactly what he is saying. Which in a sort of weird way tells me that if this is what the algos are set up to listen to him, then for all the doubts we have about him, why do you think the markets are listening to him and not to anybody else? Or do you have any opinions of that, John?
I guess because what he says is the most extreme of everybody, and he seems to act on some things as well. So, it's just he's got the most powerful job in the world, and people are taking him at his word at this stage. So again, what he says and what he does, they're not always the same, but it's just he is the driver of the stock market at the moment. Yeah. I guess that's it.
I think there's been lots of calls that people, friends of his, are front running books. There's big, especially in the betting markets. There's massive trades going on a few seconds before he sends his tweet out. The big trades are movements in oil and the equities. It could be insider trading that's going on, or else it could be just there is some algo out there that's able to interpret his tweet before it comes out onto the screens. We don't know. It's very hard to say.
It's very hard to say, and to risk something like that would be crazy for him or someone in his position. It's a lot of what he does is signaled. He says to people, "I'm doing this, and if you can interpret and figure out how he's going to act based on what he says and his behavior, I kind of think you can get ahead of it a little bit. I'm not able to. I'm not glued to every movement he makes, every tweet he makes, every time he logs into his account. But I would say it's possible. And the SEC, the Securities and Exchange Commission in the States, they are on top of stuff. They are independent to quite a large extent. I wouldn't be risking it if I was anybody. If I was a billionaire, I wouldn't be risking the rest of my life in jail to make a few extra quid. I kind of feel that people highlight this kind of stuff all the time, but the machines, the algos are so complex now, and they've got such a good insight into things. I could definitely believe they're getting ahead of things, and they're predicting when he's going to do something or say something. So that's
Jeff, you were commenting during the week about stocks like LVMH, which had a good rally, and what we call the luxury stocks. And if you could see in the XXP there, the consumer sector is up about 1.9%. Do you think that's a bit of confidence coming into to the market in terms of those stocks?
Yeah, I think they're just what you guys are saying. You're kind of right on Donald Trump, but there's sort of two markets there, really. And a lot of times there is. You have the kind of more consumer or stocks that would be affected by, let's say, prices of oil, recession, spending, consumer habits, and they're the ones that are moving on the main ones that are moving on the numbers. But you can see from your information there, like you look at the Nasdaq or look at the tech area of this XP 600. The chips and a lot of the particularly the chips, but a lot of the tech stuff is kind of grinding higher, even when there's not much news out. So people are they're finding places to put money. And then you're trading around maybe from there what sort of what's happening globally, sort of geopolitically, if that makes sense, in the other baskets. Like, so for example, BNP could be down, or LVMH, as you're saying there, is getting hammered, along with well, I suppose Estee Lauder, or the whole lot of them, Hermes. And then, when there's an announcement of some talks coming through, I think they popped both. I think that sector popped quite well. LVMH up about 5%, and the rest up too. But the chips still tend to grind higher, and the tech's still grinding higher. So there's definitely a couple of different plays there. The market, they might be sort of saying, because even if you take the AI and take all the chip spending in to do with AI and the data centers, and also to do with munitions and stuff, there's probably a demand for that even if the economy slows.
Can I add to that, Jeff? That
sure,
yesterday or last night, one of the AI darlings, CoreWeave, came out with results, and I read through the results. They're quite good. They guided slightly softer in a few areas for Q2, but in general they were a beat. Now, obviously, the cost of inputs has gone up a little bit because of the price of oil, etc. And that was the kind of main disappointment. But just in that tiny miss, from that part of it, they were down 6% yesterday, and they're down another 4% after the release. So they're down essentially they're down 10%.
You're right. I had a quick look though, and I would think that because they popped so much in the last week,
that's true. Yeah,
that they really have to justify, and I think that. That goes back, John, to a conversation maybe we had a few weeks ago about the the markets being concerned about overspend in that area.
Yeah.
And will it pay off? So once the stocks ramped up so much, and you're kind of going, yeah, they're okay, but they're still, and I think you mentioned before about their debt structuring and things like that. So if they're building on debt, and they haven't guided to sort of say, yeah, that debt's going to be decreasing soon. Right. So I think the market's just saying, yeah, we'll hold on
here. Normally when you're looking at a stock like CoreWeave, it's very hard to compare it to a traditional stock like a bank stock or an industrial stock. You've got to compare it with something like for like. And we've been looking at CoreWeave compared to, say, for example, Nebius or Coinbase or TerraWolf, one of those stocks. And we've been looking at how they've been performing and how the others have been performing, relatively speaking. But the debt structure of CoreWeave is a little bit worrying, I think, because they have quite a lot of debt, and a lot of it's financed at higher rates. So whatever profitability they make, and again, they're very their profit margins are over 50% in what they're producing. So it's quite good, but it's getting soaked up by high interest rates,
and there's a lot of competition in that space, as you said, as well. So
but their backlog though has gone through the roof. They're up to almost 100 billion quid in backlog. So it's almost doubled.
But what's the stock up on the week? I mean, just at a guess. I mean, 30%.
Let me see.
25. I mean, it is up a lot, and then I think in those ones when they're popping so much, that if there's certainly a tendency to whack them if they don't
perform,
or if they don't really super outperform. We saw that in one of them. We saw that actually last week. We were talking about the big tech stuff.
Yeah.
That they were all doing well, they were all performing well, they all beat, and yet they didn't really. A lot of them got, except Google, a lot of them got hit because of their AI overspend.
Yeah, and again, I'd like to point out back then that for me, the that highlighted that most was Meta. They were down 6 to 8% on what seemed to be really good results because they were overspending because their capex had gone up so much. But and they're investing more heavily in AI than expected. But again, to me, that's a complete plus. They did dip down to 600s. They were previously trading at 670s, and so they actually had gone down over 10% at one stage within 2 days of announcing the results. And for me, you take a company like Nebius, whose biggest customer is actually Meta, and Meta are making all this cash, and they say they're going to plow it into AI. I would have thought that that's perfect for a company like Nebius, but Nebius actually had a negative reaction to that initially. Yeah, I think it was a day and a half before it kind of absorbed the information fully. But to me, that was an opportunity to buy stock like that in terms of, yes, there's more money flowing in there, and there's more money available to flow in there, and its main customer is actually doing really well.
Yeah,
and they're committing more to the actual stock.
yeah,
So
I think you're bang on. But just remember, I think it even before that it had ramped up.
yeah,
And therefore, it's hard then. It's the
it was
market
taking
digested
pause.
a bit
Yeah,
softer, and then it did leap on, as you said, after that.
yeah. But
I think
it was a
it's
good day and a half back, though. That was the point there.
I think you always have to keep in mind that these stocks are valued on forward earnings, and there does come a day when the PE ratios start to fall down to what the stock actually is, because they're based on their growth. So you get these. So you do get these wild swings, 10% up and downs, because the perception of, as these companies are gathering more cash in and doing better and better and better, then their PE ratio starts to level up with what the expectations are, and I think that's why you get these giant moves. I think.
Oh yeah. I mean, no one knows where these things are going to end up. Are they going to be 100 billion quid companies or trillion quid companies? And everyone's looking for minuscule, clues in the numbers. Oh, it could be here. It could be here.
Yeah.
So and these moves are justifiable. And if you have a crystal ball and you can figure this stuff out, you're doing
Okay,
well.
moving on to the portfolios. Pretty much the lads are unchanged. Puma is the savior here. Vivendi paid a dividend there 2 weeks ago, so we obviously have to include that. And just in terms of the market return, I also included 3% return on each of the two things. So it's the XXP 600 and which is what we compare ourselves to. So the two lads are unchanged. I'm down about 3.7%. Vivendi again is the one killing me, but I'm still going to add, obviously, to make the portfolio bigger. So this week we're not adding any stocks to it. This week we are just going to just have a quick look at the waiting room. By the way, Puma is 8% away. I was just telling the lads, believe it or not, I got down to 23.79 and I was 23.50 bid and I missed it, which is infuriating. But that's life. And then John is about 10% away from his gold trade. Again, this is something which could happen in the next weeks or months. We're in no major rush for any of these things to happen. So this week we were just going to have a quick. Well, do you guys want to comment on anything on the portfolios? It's still the same story. If anyone wants
I bought. Maybe put in the what was it called? Accenture. I bought that. I think after the last meeting when you guys are buying the other one, the Cognizant.
Okay.
So we can put it later on.
Okay, so you want to add that to the portfolio, Accenture?
Well, I did buy it, so I suppose
Okay, what's that?
I mean, you could wait till it goes up 10% and then say it. Right, that'll be easier.
Okay, I'll ask you afterwards. What price you?
Well, it's relatively unchanged. Yeah.
Okay, so it's on. So I'll just take it where it is. Okay, so we're still Puma. We're still waiting for the news story. If anyone wants to see why we did these shares, I will put links below for each of the podcasts that we did. They're only about a half an hour long, and you can scroll or you can fast forward to 15 minutes in. And generally, what we do is we spend 15 minutes on the stock. So I'll leave the links below, which is our reasons for buying it. So today we were just going to have a quick discussion on capital gains tax and dividends. Now, it's not very exciting, but it's pretty important that as people who are investing, that you become aware that these are penalties you have to pay. It's just the way of life. You got to pay your taxes. And sometimes traders, they say to themselves, well, I lost X amount of money this year. I made X amount of money. Asher will just wipe it off. But revenue doesn't work that way. Revenue is looking at how you have made your money. Have you paid your proper taxes? So on the capital gains tax Jeff, the portfolios we have here, it's obviously it goes from tax year to tax year, right? So whatever. And what is your understanding of how
there is no tax if you don't dispose of an asset, right?
Okay.
So if you buy an asset, i.e. the shares or property, and you buy it and it goes up and you make a profit, you have to pay 33% capital gains on that. That's the tax you'd pay.
Yep.
So, for example, if you bought 10,000 euros worth of Iberdrola and you made 1,000, I'll adjust it in a second, but you would pay 330 euros, and you declare that on your form.
Okay.
There is, however, an exemption level or sort of allowance of say 1,270 per year.
1,270 per year.
Yeah, so even if you're trucking away and you're up a certain amount, but you didn't want to sell any of your portfolio, you can always sell a certain amount to close that gain. It's not much, but I mean, it's tax free, so you might as well avail of the tax free element,
Okay, so that's obviously not that's not rollable year into year. Okay, that's just
no, it's not rollable year to year, and it's not also unless you have a joint account set up. If you're doing it with, if you're married, but it's the account's in your name, you don't get double that amount. So if you had a joint account, I'm sure you get double that amount.
Okay. Can I ask you a question then? So say you have 10,000 of one stock, which makes 1,000 in your portfolio.
Mm-hmm.
Then you have 10,000 of another stock that loses 1,000. So your net gain on the 20,000 is 0. Are you liable for capital gains tax on the?
No, you haven't made a gain, right? So I mean, you haven't made a gain. So I mean, if you sold, no, you're not. Bottom line.
Yeah, one is offsettable against the other with CGT.
Yes.
Okay.
But so, the one thing on, it's funny, like it's funny, I don't know. You saw certainly last few years, maybe not this year, but Bitcoin going up and up and up and up, and people jumping on board and making profit. Now, if they didn't sell the Bitcoin or didn't sell the cryptocurrencies, they're not liable for any capital gains tax because they haven't cashed it in.
Yeah.
But when you're making fantastic profits, or like some people maybe have, it's hard then to think if you have to turn around and pay 33% of that in tax, because it just seems like it's digital, it's online, it's over there. But certainly, I don't know if revenue can. I'm sure they have ways of chasing up or finding out. I'm sure they'd see your bank account would change, or but then they don't go into your bank account. So a lot of people kind of feel, oh, sure, I can get rid of that or hide that or don't worry about it. But typically, it's your responsibility to pay the tax.
Yeah, most I think most brokers, we trade with Interactive Brokers. Well, I do anyway, and they have your taxation forms, which they, I believe, send to revenue every year, saying that it's just a quick email to them saying that this PPS number has did the following trades.
Yeah, you're right. So that would be certainly, like I have the Gero account, for example, and I have a couple of other ones, but on that, I'm sure they strip that off and send it to revenue, and it shows whatever it is. But it's still up to me to declare it. But with the Bitcoin stuff, and I'm not fully aware, John, or yourself, Phil, might know more. But if you're buying stuff through wallets, and whatever you purchase it, maybe you send money from your bank into a wallet, you buy the stuff, you store it in a wallet. If you're not doing it through the exchange, or you're not doing it, like I don't know, maybe there's other ways, but that it's a little more obscure, if that makes sense.
Yeah, just about the Bitcoin, you still have an obligation to report everything you do to revenue. If you buy it and then sell it for profit, that has to be reported to revenue. How difficult it is for revenue to track what you're doing, I'm not sure, but when you eventually try and introduce the money you've made into the system, revenue will get you then. You can't, if you've made.
Yeah, but I think that's what I'm saying, though. It seems the way that, because if say you sell it and put the money to your bank account, let's say it's 20, 30,000. Sometimes you kind of feel, well, actually, nobody really knows that. And it's bells ring. It's a little less transparent. And that's, you're right. The obligation there is on you. And
just so people are aware, if there's more than a 15,000 euro transaction, the bank will automatically report to revenue. So if you transfer from a wallet into your account, it'll get reported to revenue. I've heard in some cases with credit unions, it's as low as 5,000 in places. those
Yeah.
those transactions above that. But the thing is, if you're making money, pay your taxes, get it done. Don't muck around with revenue. That'll bite you in the ass, and there'll be interest and penalties and everything attached. It's
Yeah.
the one person you don't mess with.
So just to finish off with capital gains tax, Jeff, if I had bought Bitcoin 10 years ago for say $1,000, first
For
of all,
50p.
first of all, I wouldn't be here talking to you guys, to be honest.
Yeah.
Anyway,
Will you be on a beach talking to us?
Yeah.
We'd all be with you. We'd all be
Yeah.
surrounding you.
if I had, so if I bought 1,000 over the 10 years, I've missed the 1,270 allowance every year, obviously. So if I sell it this year for say 100,000, revenue is going to ask me for 33,000
Roughly, yeah.
dollars. Or
They're not going to ask you. You're going to report it, and then you're going to pay it, and then if as John said, like they'll do the investigation. Maybe you don't want to hang it over you anyway, right?
No, it's hanging over your life. You know,
But
it's
the only
just
thing I think there's no, if you buy stocks and sell stocks in the pension, there's no capital gains in that.
Okay, very good.
It's a very efficient way of doing it, actually. Yeah.
And that's that capital gains in your pension, then, Jeff. That never, even when you cash in your pension, there is no capital gains to pay.
No, you pay income tax, but well, not to go too the details. We were chatting about it earlier, but you pay income tax. So you get 25%, tax free, and you pay income tax on withdrawals. So depending on how much you withdraw and how logical or efficient you are, the tax rate will be quite low. Or you could go bazooka and withdraw a whole load of money and pay big tax. But typically, you can work your taxes in a logical way there.
Okay, John, we were going to talk about dirt tax, which is this only with Ireland, this dirt tax, deposit income revenue tax, or sorry, dividend income revenue?
Oh, it's all around the place. But Ireland, every country has their own interest tax. Can I just add one small point on CGT, capital gains tax? Again, what may be something for people who are only investing a few thousand euros, or sorry, who are investing a few thousand euros. If, for example, I had 5,000 euros in the market, and I had 2,000 in one share and 3,000 in the other share, and one share went up by 1,200 euros in value, the other one went down by 1,200 euros in value. My strategy there would be I would actually sell out the share that went up 1,200 euros in value that year, and then a month later I'd buy it back and end up with the same position. I pay no tax on that because it's below the 1,270 euro threshold. But the following year, it's an effective way of rolling your tax-free allowance into the following year. I'd always look to use up that 1,270 euros in tax-free allowance. Again, and it's more relevant for people with a portfolio who are new to it. Maybe they're investing, say, 5,000 to 10,000 euros over 3 or 4 shares. So if you have a profitable share, always make sure you lock in about 1,200 euros in profit, just so you can effectively roll that tax-free allowance into the next year. It's just one way of doing it.
Okay, but just for anyone watching, Jeff, John is talking to me. He's not talking to the listeners. You do what you want, okay? So, yeah. So he is talking to me about this. Now, John, dividends. So dividends and dirt. So say I have a stock, 10,000 euros worth of a stock. It pays a 4% dividend, so I get 400 euros for the year. And the tax on that is, what's the tax rate on that?
Okay, well, in Ireland, this is for Irish residents, and that's what this podcast is referring to. There's an automatic dividend withholding tax of 25%. It's not your actual liability, but it's how much will automatically be stopped from the money you've been paid in dividends. Your tax liability is 0%, 20%, or 40%, plus USC, plus PRSI.
So why not?
It's basically your marginal rate of tax. There's no tax on dividends if it's within a pension. So again, a pension is a nice way to roll up money in terms of dividends and CGT, capital gains. What else? You must declare this to revenue again. You must fill out the Form 11 and declare it to revenue.
Okay, so if I have my 10,000 worth of stocks, or say 1,000 worth of stocks, and it pays a 40 euro dividend, right?
Yeah.
I have to declare to revenue that 10 euros, but that's underneath my 1,270, so I don't. Is that correct?
No. 1,270 is only CGT. It's capital gains tax. There's no allowance on the on dividends. Your dividends are added to your wages, and if you're paying tax at 40% on your wages, then you'll owe an extra 15% of tax to revenue from the money you've made. Plus you'll owe the USC and the PRSI.
Okay, so my 40 euros, my 40 euros of dividends that I get, I have to do my tax calculations on
Yes.
that 40 euros, depending on what bracket my salary is in.
Yes.
And then
And
I have to send that check to revenue.
Yes, that's it. That's it. And for 40 euros, you think, oh, it's a hassle. It is a hassle, but you still have to do it.
Yeah, well, just on that, I think though that if you have an account, they will automatically hold the dividend.
The 25% dividend holding
and
tax.
then
And
when
you
you're
make the
doing your taxes, you that goes in as an income, and you use the 25% as a credit. So you're not sending the check at the end; it's your overall taxes then that you're filling in.
Okay, so then the broker itself sends
no. So the broker will hold 25% of that, whatever dividend you got. You'll get the 75%. Then at the end of the year, when you're doing your taxes, you'll fill in whatever dividends.
Yep.
You'll have a tax credit of 25%. And then depending on what your marginal rate of tax is, you'll either get the small amount back or you'll pay more.
Ah, I see.
I typically assume you pay more because most people that are doing stocks and stuff probably have a little bit more, right? They're probably in the higher bracket. They have more disposable income, I guess.
So it's a massive benefit to trade these in your pensions then. It just is.
Absolutely, yeah, absolutely. Yeah. The other side of it, is that if you have a very, very low income, then there's potentially no tax owed, and you'll actually get the refund of the 25% withholding tax that's been paid. So if for example you're a pensioner, you're getting 13, 14 grand a year in state pension, and that's your main income, you can earn up to 80. You can get up to 18 grand a year completely tax free. So if you're getting 1,000 quid in dividends a year, there'll be no tax on that. Okay, and I'll just add as well, for foreign dividends, they're also taxable in Ireland too, but very possible you'll get a credit based on how much tax you pay, for example, in Spain or France on those dividends, or how much is withheld at that stage.
So do you guys know, if I buy, say, Lloyds Bank in the UK, they have a withholding tax, that then there's obviously a tax treaty between Ireland and the UK. So that's then taken into account according to the tax treaties again on my taxation.
Yeah, basically you're given the credit for the amount of tax you've paid, and then you pay the balance versus your marginal rate of tax back in Ireland.
Now, we're just going to finish off with ETFs, John. These are exchange traded funds. These are technically, what's the best way to describe an ETF? It's a collection of
everything.
Yeah, actually, that's it. It's actually it's a representation of the underlying market. So if you're buying the FTSE 100 and there's an ETF, the ETF will reflect what the FTSE 100 does.
Yeah, exactly. ETFs are great ways to get exposure to the overall market. The FTSE 100, whatever it trades at, say for example, it trades at 10,000. If you want to buy one FTSE future, it's 100 grand's worth of shares. It's most people can't do that. ETFs allow you to buy smaller amounts of that, maybe 1,000 quid, 500 quid, 10,000 quid, whatever you want. So you get broad market diversity, and it's again, it's an easy way to get a diversified portfolio. Now, ETFs are great in pensions because there's no tax in them. Like, pensions are a really good way to build up cash if you don't need it in the near future. But if you're investing in an ETF, you buy an ETF for 1,000, and you buy another ETF for a different one for 1,000. One goes down to 500, one goes up by 500. You can't offset them. Unlike CGT with individual shares, you can't offset a winning ETF against a losing ETF, and you actually pay 38% tax. Now it's come down from 41%, but 38% is quite high. So you could put 1,000 quid into one share, make 500 quid, 1,000 quid into another share, lose 500 quid, and your tax bill into an ETF, sorry, and you'll still have 190 quid tax bill, even though you've made nothing. So not a great way to, if you're doing short-term trading, not a great thing to do. You know,
Oh, that's quite a penalty for an
it
underlying.
is. Yeah.
Obviously, yeah. Obviously, it's treated as an asset, not as a share or not
Yeah,
as
it's completely different. And also there's a thing called distributed, sort of deemed distribution. So every 8 years, it's assumed you cashed in the ETF and you have to pay tax on it. So it's not like you can just run it for like 20 years and watch it go up and down. So if for example, after 8 years, your shares come from 1,000, so your ETFs come from 1,000 to 2,000, you pay 380 quid in taxes. And then the following year it comes back down to 1,000, you're down 380 quid, you know.
Genie, man. Does that have the same behavior inside a pension, or do you know? So
No,
if you buy
there's none of that inside of pension. Pension, as I say, a pension. I
wow.
think I think an ETF is a very good tool for a pension because it gives you diversification, and you don't have to worry about those tax implications.
Jeff, do you have any comment on ETFs yourself in terms of do you see it as
No,
a
I
good?
think I have an ETF in my pension, which I've had for a long, long time. Just let it run, you know.
Yeah.
So it's
It seems a great idea for trading because, as you say, John, to buy one FTSE is 100,000, but to buy one FTSE ETF, you can probably do it for 1,000, probably.
Yeah.
Well, you buy, yeah. So if you want to buy 3,000 or 8,000, you buy that amount in that in the product,
Wow.
you know. So it is, yeah, it's a handy way to do it.
Okay, listen, lads, that's fantastic. That's taught me a hell of a lot about tax. Anyone from Revy listening, I look forward to paying you my tax, hopefully, on my income. So,
if I make 2 million quid, I will gladly pay my taxes. If I make
Yeah,
10 million
yeah.
quid, you can double my taxes. I won't care.
well, I wouldn't say that now, John.
Well, are you going to edit? If you're editing this afterwards, I can make comments. If you're not, I'll say.
Okay.
God, no, I never heard that out.
But as I say, ETFs they're a kind of funny thing. There are a couple of anomalies within the actual shares as well in terms of cashing them in and inheritance and all that kind of stuff. If people want to send in some questions about them, we can answer them. But they're quite detailed, and we could put them up on the website or whatever we've coming.
Okay, just to tell our viewers that the lads are QFAs, so they're qualified financial analysts. Is it analysts?
Advisors.
Advisors even. So they are qualified. So if you do have any questions, just drop them in the comments box, and hopefully we'll get back to you and be able to answer the questions. Obviously, with this podcast and all the thing, nothing is legally bound here. The lads are talking to me; they're not talking to you. So whatever you do is up to you. I am just learning a lot from these guys. That's my so. We look forward to coming you back next week. Next week we're going to pick a stock again. I think John, whose turn is it? You or Jeff? I did Unilever this week.
Well, I think maybe I think I'll do the next one if that's okay, guys.
Okay. Yeah.
We're going to have a look at one or two AI stocks. Now, there's no point in looking at an AI stock in isolation. You need a comparison. You need something to compare it to. So probably we're going to look at Nebius and CoreWeave. Nebius, we're going to have the results out on the 13th of May. CoreWeave had the results yesterday. So we can do a little breakdown of the results, why the shares move so much, and hopefully we can highlight some of the pitfalls in investing in these kind of stocks and some of the advantages. And, just again, people can take it themselves from there.
Okay, that's great. Are we all good, lads?
Yeah, great. Listen, thanks very much, Phil. Thanks, Jeff.
Yeah, cheers, guys. Thanks a lot, right?
Look forward to next week. Yeah. Okay.
Cheers. Bye.
Take care. Bye. Bye-bye.